All of us have heard growing up that investing in the stock market is quite risky and people tend to lose a lot of money in the stock market, etc. But there's a lot of ways to manage this risk of losing money. So, just like when a child, you wouldn't expect a child to cross the road by itself. You slowly teach it to cross the road first by holding your hand, then teach the child to look, listen, and then cross the road. You teach them to use zebra crossings and things. So, you can teach them to manage the risk of crossing the roads. Similarly, there's a lot of ways to manage investment risk that I've learned from some years of investing and a lot of reading and research. So I wanted to share this knowledge with you. Hi, my name is Jeena and welcome to my channel. So, in my opinion, not investing is a bigger risk than investing itself. So, imagine you are running a race and the target keeps moving away and away. So, you're running your race all your life. So, all of us know that inflation is a silent killer, and each year, due to inflation, we lose the buying power of our money. So it's like similarly, we keep running towards the goalpost of say £100,000, and the goalpost gets further and further away because what you can get for £100,000 becomes less and less with each passing year. So inflation is a risk, but not investing is a bigger risk as well. So let's look at how we can manage the risk of investing. The first risk is your behavior. So let's just take an easy example. Say you have 100 shares of a company and that's cost you £1,000. So let's just say it's Amazon. You'll never get Amazon for 100 shares of Amazon for £1,000, but let's just take that as an example. So let's imagine that the market falls by say 20%. So then your number of shares is still 100, but the value of the shares becomes £800. So at this point, it is a paper loss. Also, on paper, you've lost £200, but you still have 100 shares of that company. So, but if you panic and sell, then your paper loss becomes a real loss. But if you can hold your nerve and wait for the market to recover, because over the short term, the market is fluctuating, but over the long term, the market goes up in value. So if you hold on to your nerve over the long term, the market will pick up and you will recover those shares. But so if you sell at that panic moment, then you make an actual loss. So it is down to your behavior that you made the loss, not because you still hold 100 shares of that company, and it is you who changed that paper loss to an actual loss. There's a famous quote by a person called Nick Murray, who's very famous in the investing world. He says investment performance doesn't determine real life returns, investor behavior does. But we've all heard of companies that actually lost all its value and it's gone completely insolvent. So recently, there's been lots of companies that's gone bankrupt. There's been Debenhams, there's been Mothercare, there's been Toys R Us. There's several companies. Which brings me nicely on to point number 2, which is diversification. Diversification is the only free lunch when it comes to the investing world. We should never concentrate all our money on a handful of companies, on 20, 30, 50 companies. First of all, it's hard to monitor those companies individually. And secondly, our risk is much less if you have it in a fund. I invest most of my money in a globally diversified fund, which is investing in, say, I don't know how many companies are there in a globally diversified fund, but say 10,000 best companies in the whole wide world. I put my money in all the 10,000 companies. And yes, investing in a globally diversified fund, your investment returns might be less, but always remember that investment risk and returns have a love-hate relationship. The more risk you take, the more returns you have, but then more risk your money is. The less risk you have, the safer your money is. So to keep your money as safe as possible, I always recommend having a core portfolio as well as satellite portfolio. Satellite portfolios only if you want it. The main bulk of your investments, 80-85% of your investment should be in your core portfolio, which should be a globally diversified fund. And then if you want to be more creative, you can add particular sectors or individual shares only if you want to be more creative. I have most of my money in a globally diversified fund. I've got a few satellite investments. I've got an S&P 500, just a satellite investment, also an emerging market fund, just to add a little bit more diversification. But I've already got most of my money in the globally diversified fund. So there is two schools of thought when it comes to investing risk. One is age-based risk, and the second one is goal-based risk. I prefer the goal-based risk, and I'll come to that in a minute. So age-based investing is investing as per your age. So if you're in your 30s, you put 30% in bonds and 70% in equities. If you're in your 40s, you put 40% in bonds, which is a very stable investment, and 60% in equities, and even you're in your 50s, you split it in half, and the further you go towards retirement, you hold more and more of the stable investment, which is bonds. I do not like this approach because you play it very cautiously. I prefer to have goal-based investing, where you invest for a certain goal, then you can allocate the risk as per the certain goal. I've done a previous video on this. It should appear over my head now, so feel free to check it out, where I've gone into detail about goal-based investing, but just very briefly, if you're investing under 3 years, hold that money in cash. Do not expose it to the volatility of the stock market. Between 3 and 5 to 6 years, use a moderate risk fund, and any money that you need past 6 years, go into a high risk investment. There is two situations in life where you would not do goal-based investing. So you would do it differently. If number one, if you have sleepless nights. So if you are an anxious person and you want to check your portfolio about 15 times a day, then you want to reduce the risk of investing. So nothing is worth sleepless nights. So reduce the risk and have some peace of mind. So even if you do not have the large returns, you have the peace of mind and you can sleep comfortably at night. So that is reason number one. You would not expose yourself to maximal risk. So that is understanding your attitude for risk. So if you're a nervous person, reduce your risk. The second time you would not do goal-based investing is if you have large amounts of money saved up. So I'll give you an example to understand this easily. So let's say you've invested £1,000 in the stock market, and the stock market dips by 20%. And now your investment is £800. So if you've got a steady job and you've got money coming in, that £200 reduction, you can sort of stomach it. But now let's just say, imagine you've saved for years and you've collected £100,000 invested in the stock market. And now it again reduces by 20%, but now it becomes £200,000. So that is a bigger amount to swallow, isn't it? So the more money you have in the stock market, the less risk you take. So for some of us, it'll be £100,000. Some of us will be £500,000. Some of us will be £1 million. So it again comes down to your attitude for risk. So these are the two times you would change from goals-based investing. The next big point to reduce your risk is to review your portfolio annually. So this is to review your time scale. So if you're getting closer to 3 years, then you want to de-risk your money. Also, you want to look at your the money that you've collected. So perhaps you've collected larger sums of money and you want to reduce your risk. So review your portfolio every year just to make sure you're keeping on top of your risk and your portfolio is nice and tidy. The last thing to do to manage your risk is to buy things when it's on sale. My husband sort of teases me if we go into a clothes shop. He says I put my head up and look if there's any sale boards and then run towards the sale aisles. Similarly, there will be stock market sales over the years. So it's been said that there is a market correction of a decline of 10% once or twice a year, and every so many years there is a stock market bear market, which is a reduction of 20% or more. So this gone past year in 2020 we had a bear market. So try and get all your stocks on sale when there is a bear market or when there is a correction. So instead of running away from it and being frightful that the market is declining, go towards it and get things on sale. So just to summarize the things that you can do to minimize your risk in the stock market, number one is watch your behavior. Number two is to diversify. Number three is to select your method of managing your risk, either age-based investing or my preferred way of goal-based investing. The fourth point is there is certain situations where you would do it differently, and I explained this in the video. Number five is to review your portfolio annually. Number six is to buy things on sale. I hope this video has given you a little bit of confidence to start investing in the stock market. If you've liked this video or if you've learned anything new from today's video, please help me back by giving me the thumbs up like button and sharing this with your family and friends. Before you go, you may want to check out these other investing videos of mine, and I'll see you on the next one. Stay safe. Bye bye.